Welcome back, Amit,
Hi,
and
thanks,
thank you again
Ashutosh.
for doing this. And so today we are going to talk about the sort of research side of the world. And as we know that this whole area of research could be very nuanced within the investment management process. So it could range from this Newtonian view of the world in terms of the numbers and precisions to all the way from having the subjectivity where you're talking to the CEOs, CFOs, the customers, the suppliers, and the building a perspective on the long term opportunities that might present themselves, from an investment standpoint. But before we dive into all of this, just tell us about why research in first place. What's the fundamental need of research and the high level components that are involved in it.
Okay, thanks once again, Ashutosh, for inviting me to your series of talks. Why research? Research in investment management is needed like you need research in any other field of life. Any investment decision you want to take, it has to be based on sound analysis of in-depth understanding of the topic before you actually go and invest money, right? It is people's money that is going into the markets. So you want to do a detailed analysis of why should I go and invest? And research is what differentiates an investor from a speculator. As Benjamin Graham says in his famous book on Intelligent Investor, is when you take a decision to spend money on buying something in the capital markets, it has to be based on fundamental ways, whether you've learned everything about that company before you do investment. And that is what research is about, collecting all possible sources of information and making a sound investment decision based on your analysis of that information and come out with the investment decision.
So talk us through some of the high level elements of research, because as I was just talking about, that there could be different ways of doing research, whether we call it methodologies or the way people approach research. So what are the different components of research from your perspective?
Okay, if we just talk about the investment world, there are three fundamental approaches which typically investors or people who go into the market tend to follow. The most prevalent is fundamental research, especially from an institutional perspective or people who really want to invest for the long term. Fundamental analysis essentially means you try to uncover the intrinsic value of a company. What are the drivers behind it? What drives the company? Is the revenues or profits of the company? And then you try and invest for the long term. It can be qualitative or quantitative based research, but again, it has to be very sound. The second way is technical analysis, which is quite the opposite of fundamental, where you completely invest based on the price pattern and the volume of trading that is happening on the stock and exchange. You try to identify patterns, and based on that, technical analysis will come out with a buy or a sell recommendation. Typically, a very short term kind of philosophy on which you buy or sell into any security or instrument. The third is a quantitative analysis approach, uh, where I think there's a very heavy use of technology, right? There's very heavy use of data which is processed, and statistical techniques are used, algorithms are used to come out to create quantitative models, based on which you create your portfolio and go and invest into the market. Essentially, the philosophy is fundamental analysis based. There's a human interface involved. Quantitative tries to make it completely away from human biases, but not sure if that's actually removed. But still, the idea is to make the investment process heavily data dependent and algorithmic dependent on technology, and that is how you go and invest into the market. So these are three different ways of which you do analysis and research. But yeah, in the end, you might end up using all three or couple of those when you actually go and make an investment decision.
So that's very interesting. You spoke about the fundamental and technical analysis, and it seems like fundamentally these are like different mindsets or different ways of doing things. Is there like an intersection between two, or is there an interplay? So, for example, if let's say you're picking up a stock or investment manager is picking up a stock, uh, how do you decide what methodology to apply? Or is this like you apply both? How does that work?
Like you said, I think both of these uh, involve a very different mindset. It's almost like fundamental is a very intensive, in-depth kind of a research process where you uncover the overall strength of a company or a instrument you're investing in. It's generally for the long term. Technical analysis is more short term, but you also see a lot of interplay, especially like fundamental analysis will help you uncover, okay, this particular stock is undervalued compared to the market. There's still a lot of value there. Technical analysis maybe can help you decide when do you enter the market. For a very short term, where you probably try and see, okay, the chart say this stock, at least for the short term, is at the bottom. That
Right.
allows you to employ the right trading strategy and you enter the market. But again, I would still, the mindset required in both of these approaches are very distinct. Technical analysis is more short term, numbers driven. Fundamental analysis much more qualitative and for the long term.
And you spoke about the, and I think in the last video also we touched upon these quantitative sort of methods, and you touched upon it today. So how's that? Talk a little bit about, that side of the world, because it seems like that's like a third way of doing things. Are you more referring to area where the sort of human need can be eliminated because you're going like more quants way? So more sort of what I mentioned, referred as not me, but I was reiterating. A lot of people mention as the Newtonian way of doing things in terms of numbers.
Yeah, so quants I think has been there for a long time in this investment management industry, and we have seen both successes and failures in this. It involves building trading strategies and investment strategies completely based on data. A big successful example is Renesas Technologies, which was set up by Jim Simmons 40 years back. And the algorithms are completely proprietary, completely driven by data, and how do they uncover patterns. In fact, Renesas Technologies hires physicists, mathematicians, computer scientists to
Right.
actually uncover patterns from data. Hardly there's any finance guy in that company. So it's completely driven by that. And it has given 60% returns, annualized returns over such a long period of time. So yeah, it is that, but you're completely dependent on how much technology you use. But there could also be pitfalls. You've seen a few years, I think a couple of decades back, there was a hedge fund LTCM, it just collapsed because of the quantitative model just kept following a data pattern that could not react in time.
Right.
And similarly, you see the global financial crisis. There are a lot of examples where it has failed as well, but yeah, there are big examples as well who have completely used those models. They get away from the human emotional bias and made successes.
That's very interesting. So I'm going to jump the topics a little bit here because you already touched upon something that we were talking about before this. We started recording this, which was about how do you measure the success of a decision, right? So, for example, let's say if there's a technological process and the bias is built into it and it's kind of replicating the issue, but I'm assuming that you could also make some mistakes when you're doing, let's say, your fundamental analysis, right? So where does that calibration and the validation of the process happen, when irrespective of, or maybe if it's specific to the methodology that you're using?
I think ultimately, purely from an investment perspective, it is the returns that you get from an investment that's in a very layman language determine the success of investment strategy.
Yeah.
But it's about typically in a mutual fund company, an asset management firm, you typically benchmark your investments against a benchmark or an index, exchange-driven index. Say if I'm able to beat Nifty over a consistent period of 10 years, the fund is doing great.
Right.
But how much of that research process has contributed? There are very detailed methodologies in actually attributing the value of, say, fundamental research in achieving those returns exceeding the benchmark returns, typically alpha that we call about in our language. But again, there are complex methodologies to determine that. As Peter Lynch says in one of his books, Beat the Street, you can maybe get everybody can get 4 out of 10 investment decisions, right? But a great fund managers he convert those 4 to 6.
Right.
So it's that, say, a 20% over
beating like the standard 50%
is something
chances of
where you see investment professionals adding value, but that also consumes a lot of energy, effort, intellectual capabilities in moving that 40% to 60%.
Okay. And is that what would then, let's say if I'm a research analyst, I'm covering a stock, let's say on which so I guess what I take from what you said is that, let's say if I have a conviction in a stock and if I go for or recommend that for investment, then my sort of proposition for selling my idea is to say that this will outperform, for example, Nifty. And that's what we are calling as alpha, right? So let's say if Nifty gives me 8% returns, if I get 10, I've probably done better. But in terms of, so talk a little bit about how does this process work? Because you spoke about mutual funds and you spoke about, this investment management firms who are kind of doing this. So purely in terms of the kind of this process between the fund managers, the research analysts, and then you last time you touched upon the trading desk. What does this process look like?
Okay, typically a research process or the research strategy has to complement the business strategy of that particular organization or the kind of investment strategy they have built in. It can't be away from that. If it's an asset management company which is looking for long-term returns for its clients, that is how the research strategy will also bake that into the process. So once the investment strategy of a firm is decided, you define on the research strategy. There could be a head of research or a CIO who defines the overall research strategy. And typically they will decide, okay, they'll have a top-down kind of an approach. These are the kind of universe of stocks or a watch list that we have. And then funnel it down to based on certain different filtering criteria. Could be based on market cap, the sectors, or different kind of criteria we also invest in. Come out with a list of research universe.
So like high level filtering of what you want to go after.
Because you can't go and there are hundreds, thousands of companies. And then based on the research team you have, you probably, some of the analysts may be specializing in a particular sector or in a particular theme or in a particular region. You start allocating stocks and then they get into research, in researching about that company. And a research process can fan out in multiple ways. One is looking at the macroeconomics fundamentals which impact that organization, then looking at the micro factors of that company. And again, reiterating how does the company generate the revenue and profits. That's an analyst would typically go through the three statements, the balance sheet, the income statement, and the cash flow to make a model. And then there is a very qualitative aspect of fundamental analysis, is where you try to understand the management of that company, the CEO, the CTO, how do they operate, what is their vision for the company, does the vision actually translate on the ground in how the company is operating, and you start to make a view around the long-term vision of the company, how does its growth prospect look like. Then you probably might use some methodologies like discounted cash flow to determine the overall present value of the company, or secondary ratios like PE ratios and EPS of the world. So it's a combination of qualitative and quantitative. You create a hypothesis, you test that hypothesis, you come out with a rating or a recommendation on that stock. Most likely will publish a research note which will summarize your thesis and what all has been done to prove it. And then the research note goes out to the fund managers, typically in a buy-side firm, where it is actually reviewed. I mean, a research analyst sometimes even act like almost a salesman because they need to sell the research idea to their fund managers. The other thing I want to highlight also is a lot of time these research themes which the analyst is focusing on, the companies is focusing on, they may not achieve immediate results. Especially in an investment world, they might take some time. It's something, a futuristic theme you have caught on. And then it might take, say, a couple of years before that fully plays out. So, and there's a constant review. Analysts just keep on reviewing the stocks almost on typically on a quarterly basis, keep publishing the research, any new information that comes out, they have to go through. So again, does it impact their research thesis or not? And the cycle continues. The fund managers then probably take investment decisions based on that.
So help us understand this difference between, because I think you spoke about, if we look at the fundamental methodologies, whether it's technical, fundamental, quants, but then then we have this other distinction that you spoke about between the buy side and the sell side. Are the motivations different? What's the difference when you're talking about buy side versus sell side?
I think, like I referred, buy side firms like asset management companies typically tend to take a long-term view of their client investment. So they generate revenue based on how long the assets are retained by them, then the returns returned on them. And that is what also reflects in their investment process as well. Analysts will take a long-term view and then publish the research. Sell-side firms, analysts in those sell-side firms also do in-depth analysis, but the sell-side firm typically will generate revenue based on the transactions, per transaction revenue. I think that is where, so typically they will send their research in a way that helps generate transactions from the institutional or the retail clients.
Right.
So in a way, the sell-side research could have a short-term view to it, But a buy side fund typically will have a long term view in terms of research. So their themes also tend to play
Right.
a bit.
So I'm going to, for the wider audience that we have, I'm going to ask you a personal question. When you started your career as a business analyst, God knows, few decades back. Let's not go there. What's the right place to start? So if I'm sort of starting off today, should I go for a course? Are there books that you recommend? What's your top recommendation? Let's say if I'm a fresher, or let's say I'm straight out of college, and we spoke about this earlier that you don't have to have a finance background to get into this. But where do I start? Let's say if I'm getting selected in one of the investment management firms or investment banks or wherever, and I want to build my knowledge in the domain or the area, the nuances that we're talking about. What is it that I should go about reading?
Okay. Typically, investment professionals, and if I talk about research analysts, typically we can classify the skills into two parts. One is the core finance or understanding of the investment knowledge, where you need to understand how basically how do you typically study the different statements
Right.
that a company releases.
So statements being like cash
balance
flows,
sheet,
balance
or the cash
sheet that you
flows, or
spoke
the
about. Yeah.
income statement we talked about earlier, to help understand the financials of company, right?
Yeah.
Whether they're right or wrong. The other key aspect of investing is, which I think Warren Buffett, he's known for his investment over the last 50 years, is the qualitative aspect. You need to understand the management, and this is where I feel what you need. I don't think it's about finance knowledge. It is about your ability to think critically.
Yeah.
Your analytical thinking. And here sometimes I feel the liberal arts background, somebody from that background can play a much better role, because there you're exposed to multiple disciplines of knowledge like philosophy and religion and arts. And this will help you critically analyze how a company is working. Right?
That's very interesting.
And that knowledge you bring into the investment process will help you deviate away from those mathematical models. I'm not saying mathematical models are not required. They are definitely required, because ultimately these are numbers that you are generating, but helps you build the understanding of the management, how that company is operating. That background helps you a lot. One of the books I was just reading where somebody said investing is the last liberal art.
Yes.
They've actually brought this whole concept of Charlie Munger, who works with the second to Berkshire in Berkshire Hathaway to Warren Buffett, where he talks about lattice work of models, right? Where he thinks, can you bring, say, a model from philosophy into investing?
Yes.
Or a model from biology, the whole concept of evolution, into investing?
That's quite interesting, because I think if you look at some of, let's say, the models used for, let's say, reduction of noise, right? Whether it's an aeroplane or whether it's a mathematical model using for AI and whatnot, I think there are probably a lot of applications agnostic of in terms of applying principles and the usage and so on. So that's very interesting. But then what you're saying is, if I do not come from a finance background, it's important for me to understand what those matrices are sort of conveying, as opposed to
think you need finance knowledge to understand those matrices, but you then need to interpret those matrices.
Yeah.
Now, everybody can come out, okay, whether this profit statement is right or wrong, the cash flows are right or wrong, but everybody, based on what they have read, will come with their own interpretation of a PE ratio, for example.
Yes.
And that, I think, what I believe is, the more read you are.
Yes.
People like Warren Buffett and Charlie, what I have ever read about them is they do a lot of reading.
Yes.
All they do is read and read.
Yes.
Because I think that what develops your brains and the way you analyze. So interpretations define the same PE ratio, say, can mean a different thing for you. It could be a buy recommendation. For me, it just could become a sell.
Yeah. Yes.
And this interpretation, I think, gets developed much more with the diversity of thought process you have, which gets developed the more you read about different subjects.
And I believe there's probably also this element of, if I'm reading a matrix, then how do I compare it, for example, with respect to its peers, or whether this is something that I look at over a period of 5 years, whether I'm looking at the trend of the metric over a 10-year. So data, and how much availability of data is there, and the ease of having access to that data probably becomes easier. So for example, if I'm analyzing trends and so on. So talk a little bit about, I think we touched upon this earlier also, but if we want to reiterate this, from a technology perspective, and especially when we're talking about quants and things like, is there a shift in the data or the sort of a technology toolkit that sits behind it, or is it like you would say it doesn't matter much? It's about your ability or acumen to understand the matrices and putting them in the perspective and
I
technology.
think definitely with the evolution of computing power and technology, it has helped us process much larger sets of data and come out with much better insights. But I think it's about generate. So technology can generate those insights,
Hmm.
but it's how do you interpret those insights? How do you infer your own insights from those technology delivered insights? I think what will drive ultimately your investment decisions, especially when you are following up completely a fundamental analysis based approach. Yeah, completely a quant based approach may not involve a human kind of interface, but in my experience, I have seen a lot of examples now where firms have started employing a combination of both.
Hmm.
It's a quant based approach plus that human as well, who is ultimately involved in making an investment decision. Not every company completely wants to go the Bridgewater way or the Renaissance way, where they're completely outsourced to technology, because it could have its pitfalls as well. Ultimately, the capability of a quant model is dependent on the data that is fed into it.
Hmm.
If the data has a bias, the investment decision will also have a bias.
Right.
And a lot of times we have seen some of these quant models are not able to determine those what we call as black swan events. Right?
Yeah.
The global
The
financial
outliers or
crisis, outlier, because they are still dependent on historic data.
yes.
And if you see the typical bell curve, there is a
Yes.
tail on the both sides, which typically most of our risk models tend to ignore.
Yeah.
But if you see those, if
Black
something,
swans or the exceptions
and
playing
these
out.
models then tend to play out in the same direction, all of those models, and then market could potentially crash as well.
Right. So it's more of the subject to this availability bias on the basis of what they're doing. They could create projections, but the events could, as things change, may not replicate themselves.
So even
That's
if you remember the financial crisis, there were still some people who made money. If you've seen the movie Big Short,
yeah.
the people who still who went into those intricacies of those documents and came out with this strategy, something would fail because the markets were overreacting. Not everybody lost money. The people who still believed
In the
in
fundamentals.
fundamentals of investing, they ended up making money.
That's a very so okay. That's brilliant, and so that's a perfect segue into diving a little bit deeper into the fundamental research side of it. I think what we wanted to do today was to just touch upon the high-level research process and the different components involved. But for our viewers, I think next we'll focus. The next segment focuses more deeply on the fundamental research side of it. Please stay connected, stay tuned, and if you have any questions, feel free to post that in the comment section or reach out to Amit or myself directly. And with that, thank you very much for joining us in this segment. And then we move on to the next one, which is more deep dive into the fundamental analysis side of it.
Thank you.
Thank you, Amit.